Is Amazon the cheapest of the Magnificent Seven stocks right now? Hello, ladies and gentlemen, and welcome back to the Daily Show where we discuss stocks, commodities, and cryptos. We'll be talking about JP Morgan's latest figures here on call contracts. They're going back to highs that we saw during April and, of course, August of last year. More importantly, they're also at similar points during the rally that we saw that took us out of a bear market in 2020. So what does this mean for traders, investors out there like you and I? We'll be talking about that along with Citi's Poll Index and, of course, the ECB. Yes, it's July. Central banks around the world will probably be rate rising 25 basis points. And on top of that, it looks like they're doing further tightening, which will come through this month. Let's get into it together. Well, welcome back, everyone, to the Daily Show where we talk about markets around the world. And it seems like deja vu with 2018 again. Potentially, we're starting to see a little bit of a trade war starting to appear. The US is reportedly planning to restrict now China's access to cloud services. And this is the heating up of the AI really competition throughout the world. We're also seeing here that China's going back and saying, well, maybe we're going to restrict some exports of chip minerals. Yes, I do think this will become a fairly important story over the next coming months and, of course, years, and we need to be on top of this one. So let's go back to the start of today's video before we go through Amazon and a few other stocks and talk about this call ratio. As I mentioned, it kind of looks similar to what we saw in 2020. As we know, many mutual funds, that is large traders, have been left on the sidelines during this rally. If you're a believer that this rally is going to continue, there's a good chance that we will still see what we call mean reversion. You usually get it every single time. The 20 weekly moving average comes back, and then you see whether the funds really mean business or not, entering into a new bull market, or of course exiting and it all being a fake move. This will be an interesting chart, and it shows us that euphoria is rising to new heights. And if the markets go to something like 4,500 or 4,530 on the SPY, then that could be a big point for us as traders and investors, something that we've been watching and looking for. We also know that July is tending to be a pretty positive time in markets. So let's talk about the first 2 to 3 weeks in July and then the rest of the year. So here are our first half returns. This is a massive year. We know this already. S&P 500, top 12 years over recorded history. Big up first half, second half return, questionable. Ignore 87. Maybe we can ignore 54 from that reasoning. And you end up getting a bit of a lackluster kind of end of the year. And this is really pretty much symptomatic of most pre-election cycles. If you take a look at this chart here, this is how we've been following so far this year, this particular seasonality. We usually have a bit more of a bump followed by a lag that comes through somewhere in July, often around July 17th. Will it be exactly that point this year? We don't know, but these are the dates. We go into a fairly strong period. In fact, the strongest rally historically since 1928 of this particular time. And then we go into a bit of a pullback, and sometimes we have a nice rally into the end of Christmas. The yield curves are finally starting to go back into where the Fed said they should be. The dot plot has been caught up by the market. Do we have rate cuts in 2023 anymore? The answer is no. This is the update here with the purple line, and you can see it's higher for longer, and then rate cuts don't actually start, potentially start even, till the first quarter of 2024. Has the market cared? The answer is, again, no. You would have thought that this would be freaking the market out, but it hasn't reacted at all to actually getting back in line with what the dot plot said. And that's interesting because we kind of suspected that this is what the Fed would do here on the channel, but it hasn't led to any sell-offs. Again, this is something that is very strange about 2023 so far. What other things have we seen happening? Well, we got our first kind of inkling that maybe a big player started to sell into this rally, or at least buy less last week with our update of course, the biggest traders fund inflows. We saw them kind of go a little bit down. And then we now need to talk about whether we want to be buying the dip in this particular rally. And if we do buy the dip, which stocks present the best value moving forward. Here's a bit of a forward PE analysis. Now, you'll note that I love forward PE, and it does work for many stocks. But for companies like Tesla and Amazon, you sometimes need to use different metrics. So on the overall 10-year average, you would say, wow, Tesla and Amazon are cheap in comparison to the others. AAPL is really expensive. Microsoft is expensive, possibly even in rip-off territory, actually, when you're thinking about them as an investor or even as a swing trader. Now, when we go over to P to S ratios, that's price to sales, Amazon might make a little bit more sense. 10-year average 2.49, still trading underneath that. And of course, here are the forward PS ratios at the end of 21, the end of 22, and you can see that it's picked up a lot from its base, similar to the other ratios. Now, if we're taking everything into consideration, is Amazon the cheapest? Well, here's another one here. And of course, this shows us again that we could be potentially seeing Amazon being on metrics the cheapest of all of these stocks. So here we have the compound annual growth rate. This is the expected compound annual growth rates. And you'll notice that Amazon comes in a little bit hotter than some of the rest. So if you take into consideration the PS ratio, the forward PE ratio, and of course the compound annual growth rate, you'll end up getting Amazon probably the best of the Magnificent Seven right now. Google also looks good by some metrics, but then it comes down a little bit when you're looking at the growth rates. And of course, Tesla, well, we'll see whether it can hold these. But so far, so good. So where does this lead us when we take a look at Monday? Well, we know that Tesla came out with a very good number in terms of their deliverables, and that turned into a big rally. We broke through some key zones. Could we be on the track to $300 for this stock? We'll take a look at it a little bit later on. More importantly, though, banks were on fire again. We saw super big moves out of Morgan Stanley, Bank of America, Wells Fargo, JP Morgan, and many regionals. And that is actually symptomatic usually of the next sector that goes when it comes to a rotation and an improvement in the markets. It usually goes something like technology, semis, consumer discretionary, finally Amazon when we talked about it a few months ago. And then we lead into usually financials as the next sector. They have been going very much underperforming. We'll take a look at those very soon in this market. Let's also talk about July market performance. As we know, we get the strongest run in the first 10 days. Then we tend to see weakness. Here are pre-election years versus the others. You can pause it at the screen here. You can also see pre-election years since July 1950, which markets are up, which markets are down. NASDAQ tends to do okay, but overall not as good in pre-election years as the other stats might make it seem. Let's also talk about surveys. Everyone's bullish at the moment. No surprises. Reminds me a lot of what happened in 2020 with these big bull runs. And we know that sentiment surveys were one of the best reads of 2022. Are they again this year? This is around the time that we should start to see the bears take control. And what we're really looking for here is huge selling. We need to see big undercover selling, dark pools, and a few other things that we'll be bringing you on the channel as we move forward. Extreme greed on the fear and greed rating, probably no surprises there. And in terms of options, we saw some large trades going through on the banks. Notice here, JP Morgan, 2.24 times the 90-day average. We also saw a little bit of a pickup in things around stuff like Zoom, which is a stock we've been talking about recently. And of course, anything to do with EV was very, very hot on the Monday trade. Every single one of the stocks was running up that was basically to do with EV. The option volume was horrible, 61% calls, one of the biggest reads I've seen so far, probably due to Tesla more than anything else. But yeah, 61% calls, 39% puts, continues this basically movement into calls only in these markets. These charts are going to be a little bit dirty when we take a look at rotation, but as you would know, if you've been watching the channel for a while, we've seen a pickup in the recent 5 days in clean energy, consumer discretionary, led mostly by Amazon and Tesla. And then, of course, we have semiconductors and now financials. Look at that, 3.76% by financials. When we have a look at the Monday trade, financials were in the middle at 0.56, but as we can see, there were quite a few quality stocks coming through at around those points. And we again had some of the defensives actually poking their heads out. XLP and XLU, some underperformers recently, started to come into their own around this time. Let's move over to one of our favorite reads, which is, of course, Magma. This is Microsoft, Apple, Google, Meta, and Amazon. And what it's showing us is the strong outperformance of these stocks. Basically, everyone's in these stocks right now. If we are going to see mean reversion, which is to pull back to the 20-weekly moving average, I want to see weakness here. And we haven't actually seen any turnarounds in Magma or semiconductors at this point, the two leaders. The volatility or the VIX market is certainly not showing us any signs of pickup just yet. We're looking for probably something like a TD13 here. We have not seen a TD13 yet. I think we're on a TD9 in the under kind of hours on the daily, etc. So again, it's possible that the VIX spikes up soon, but we are in the strongest period of the year for markets. The skew index is not getting crushed again. We need to see that start getting crushed if you want markets to turn around. Otherwise, it's just kind of floating around where everyone believes a black swan event is coming. And PCC remains hovering down at the lows, really stacking up those calls and allowing the market potentially some breathing space. One of the things that we had a big problem of throughout most of the back end of 2022 into now is there were just too many puts in the market. They're starting to evaporate a little bit as they expire. We can see here that central bank liquidity is well underneath the current price of the market. If I put the Qs on this chart, it gets even worse. Let's do that together right now. You can see how much discrepancy there really is. I haven't seen this since 2018-19, and during that time, the Federal Reserve was also cutting rates. So basically, it shows you that as a swing trader, as an investor, this market should be potentially, you should be cautious. Does that mean you sell all your investments? Probably not, but maybe you consider having some gunpowder or some powder on the side just in case you do get a cheaper price over the next coming months. Remember, these are the weakest months that we see in pre-election years. US 2-year versus 10-year yield inversion still remains really high. Until this goes back below the 1%, we usually don't see any kind of recession actually being called. We're watching that. And as we know, this is all about acceleration of yields. So have the yields accelerated? Yeah, they're starting to. And that should usually affect the markets in the future. But at this stage, we're not on new highs. Mark out the US 2-year new high. If that does happen, I wouldn't be surprised at all for that to be a catalyst in markets. What about the dollar index? Well, it's liking the new yield highs. We saw it hit into our zone where we thought weakness might come in. And we've kind of came off this area quite a few times now. 102.43 is what we call a defended zone. So basically at the moment, the bulls like this area. If the bears manage to bust this zone, we probably move back down to 102, maybe even a little bit lower. But if we do end up busting this, I would say bears at the moment sit above. If they manage to bust, they move it down. Bulls sit around here. And the dollar index remains now in a little bit of a sideways market on the smaller time frames. This is leading gold to also find some rallies. Not quite into our supply yet for gold, but we theorized when we saw this move here that pullback would be met by bull demand and we would move to this area. So I guess at this stage, we're looking towards bullish move here on the smaller time frames for gold and possibly quite a few other currencies as well. So maybe a little bit of weakness from the dollar and a little bit of strength from gold just to get it back into the $19.35 to $40. That was something we talked about on the weekend video. Tesla blew through this resistance. Of course, we came into a news announcement, which was the deliveries, and we saw the deliveries beat expectations, even with the rate, even with the cuts and the cheapness that was going through. And then we effectively now have a market which is basically just jumping out. Now, is this a false break? We probably can't really suspect that it is. The next technical big level here for Tesla is $300. So I'm not much on taking this as a breakout momentum style trade, but if you're in it, you're probably celebrating because you were seeing some weakness signs and then all of a sudden it's out here. If the market does start to weaken though, and you go back underneath that zone there, that's going to be a problem. So we'll talk about that should it happen. But for now, you're probably celebrating the fact that it's come out and you're looking for that $300 on this particular stock at this point. Could that be the high for Tesla? We'll find out. Speaking of stocks that could have breakouts soon, we've talked about a few of them recently. One of those has been Zoom. Of course, it has had a decent amount of options trade on it. Retail traders are trying to pick this one up. It's more of a retail style trade to try to get that momentum push. We saw a little bit of bullishness through the Monday session, but still no breakout of 72. We need above 72 to really trigger, a nice $2 plus movement in this. We've also got PayPal that started to turn around again, looking a bit better. And another one that we've been looking at recently has been Snow, which is kind of sitting in like an SOS. So if this manages to break through that 194 area, it could be on for a bit of a run. And recently we've done this on a few stocks, SoFi, PLTR, and of course Intel. We've had similar runs because retail traders have piled in as well on those particular stocks. Most of those have finished now. I think Intel could be still okay, but to me, SoFi and PLTR just show nothing really that great. Speaking of no sell-offs, we still don't have semiconductors weakening yet. If they do, we know our levels. If semis make a new high, we can then mark this zone here. But at this stage, semis are still in a bull trend, so very, very difficult to fade a market where semiconductors and magma are still so bullish. Let's move over to defensives. Did we see a defensive move? Yes, we've got an island reversal on utilities. That led into a really nice Monday trade, in my opinion. It was one of the better sectors, so finally defensives coming through. And I'd like to see continued movement into defensives. As if the SPX keeps moving up and we see defensives go 2 to 3 days in a row, which we haven't seen in a very long time, as you would know, especially 3 days, that's usually a sign of rotation before some kind of fall off. Let's have a look at the ASX 200. At the moment, 70.50 was too much for it, and it's rallied back up. Now, I've been a bit of a bear on this market for quite some time, and we've seen a lot of sell-offs into this area. I've been looking for 6,900, of course, and at this stage, we have got back to the 61.8. So it's kind of time for the market bears to get reinvigorated in the ASX if they're going to. I believe it'll take the US's lead in this case, and you can see that we're at these points. Now, we mentioned before that the ECB should be doing a 25 basis point hike in July, and also that we're probably going to see further economic tightening. Now, the problem with QE, or quantitative tightening in this case, is that, yes, they're going to do a doubling of tightening in July, according to what they've said. That's actually a fairly big deal until we actually see it, how much or how slow it's going to take them to actually even reverse any of the things that they've done since 2020. Yeah, they won't be able to tighten much, it looks like. But more importantly, we've got a TD9 on the DAX at all-time highs. You know, this is a zone that I certainly would be very, very cautious on if I was a DAX trader. I'm all about, following the trend. That there's absolutely the trend here is very, very strong. But I just get enough reads here to think, well, is this a Wyckoff forming? We have our buyers climax. We have our AR rally. Is this a UT? I don't know. Is this going to sell off and now make a new low? If it does, that's going to pretty much tell us that we were in a Wyckoff distribution. I'm very cautious here. If we do end up getting new breakouts and then, of course, we keep running, well, could go to 17,000. Who knows? But overall, this is starting to look like it could be distribution. We're looking for the signs of big volume trades coming through. And I'll bring you updates on that because I think that market's starting to get a bit interesting. US 2000 comes back to the most traded zone. We've seen a bit of selling through here. Previous supply, we know that this was a big key level for us before. It's now or never. It really needs to sell. If it takes a high, it needs to fade that high pretty quickly. And if you're looking for bull strength due to this pickup in banks, of course, regional banks would be your pick here. And if we take a look at KRE, which makes up over 20%, I believe, of the Russell 2000, and we have a look at how that's been trading, you'll notice here on the 2 hour that it's actually kind of like gapped down and then started to move back up again after finding a bit of a base. Not sure if KRE is going to find it, but if you look at things like XLF at the moment, which is, of course, financials, you can see they've broken out here. Financials having a strong couple of days session. JP Morgan, in particular, one of the stocks that, you can see here is getting broken out from its highs. So if banks are running, regional banks are running, the Russell 2000 may be a little bit stronger. And do remember, the biggest problem of 2023 so far has been breadth. So breadth has started to improve as well. Even if we do start to see sell-off in tech, we might not see it necessarily through the broader market. And that's something we'll be watching. Do we actually see an uptick of breadth? Around this time in 2020 was where we saw the rest of the market start to pick up. Financials, breadth in general, other sector stocks. US 30, sitting at resistance. Nothing much to say about that. At the supply, Dow poised to break out. No breakout yet. S&P 500 is on the 2 standard Bollinger weekly moving average kind of area here. So you can see the Bollinger, it's outside of it. This is a huge deal. Whenever we see Bollingers outside of the standard deviation, I always pay attention. A swing trader loves to see this. It usually means that we could be getting a new trend soon. And if this market pushes hard this week, 45.30 pushes into our red boxes around here, this could be a massive turn point for the S&P 500. I'm waiting, I'm watching. This is usually symptomatic. We saw, of course, that first sell-off, but what we're actually looking for now is a wick. We need a big wick, similar to what happened down here. If we do get a big extension here this week or the next week, I want to see a big rejection come off it, similar to this, and that will show us that the trap has been laid, and of course, markets could turn. But for now, yes, this market is still theoretically bullish, and of course, it broke out there again. You can see how it gapped all of our Fibonacci's over here, left a big gap. Pullback back to the gap seems probably plausible, maybe even through a July rally. And then if we go like this, well, we'll know what's probably happening at that point. Now, this was where we got the first turn sign for swing traders. It rallied, came back to exactly where you would expect it to usually sell. And then, as I said, it just kind of gapped through. So there was no real trigger there. And I think that's the important thing. You have to have patience whenever you're playing these trades, but more importantly, scale in. So let's say you'd pulled the trigger on the S&P 500. Let's say you'd said, okay, cool, break below. I'm going to take a position. Maybe it's a third of a position. Then it pulls back to here. Maybe you would then say, okay, I'm looking for a turn point. If you see the turn point, you add 2/3 of your position back into the short and you get involved. And that usually keeps you out of a lot more trouble. Pulling all of your money in just because you want to try to follow, a very aggressive movement in action. Unfortunately, where are you going to put your stop loss? How much risk reward are you going to make? Always think about those things. It always becomes pretty important. So at the moment, we're above the highs. That's where we kind of find ourselves. Let's have a look at the NASDAQ as well, just to get a bit of an idea. It still hasn't made a new high. It's hovering around these points. And again, it's going to be a very important week here to see how it ends up reacting. So far, very, very slow through the 4th of July long weekend. So almost no trade coming in here. Bitcoin also trapped throughout this period. We've seen the low hold as demand. We've seen the high hold as resistance. We're trapped in, is it distribution or is it accumulation? I'm pretty sure we're going to find out, and we're going to be able to react to this pretty soon. Key point here for Bitcoin, if it breaks out to the upside and holds it, it could be on a very large move, maybe upwards of even $10,000 a coin that could come through here fairly quickly. It's been lagging, as we know, the NASDAQ and the rally that we see there, so it could be a big deal. When we move over to the news for the week, just remember that this week is non-farm payrolls. We also have a bunch of other stuff coming through. We've got Wednesday FOMC meeting minutes, OPEC's in today, so that's going to be big for oil. We'll cover oil afterwards. And then we get ISM services, PMI, JOLTS job openings, and of course, non-farm payrolls, etc., etc. This is going to be the big one, 8:30 a.m. We'll be looking at it very, very closely. In regards to everyone that entered our competition, I'll have the results for you guys tomorrow. I'll draw them live on the video, so make sure to stay tuned for that. And good luck to anybody that's entered. Bye for now, and subscribe and smash the like button if you enjoy our videos. See ya.